Hello and welcome to Chapter 9. Chapter 9, we're going to talk about plant assets, natural resources, and intangible assets. Collectively, you might call these assets long-lived assets because they have a useful life that is greater than a year. They provide utility for a company that is greater than a year. And these assets are treated a little bit differently because you have to follow something called the matching principle, where you want to match revenues and expenses. We're going to expand a little bit on some of the stuff that we talked about in Chapter 4, which is called depreciation. We're going to look at depreciation, amortization, and depletion. Depreciation is used for plant assets. Depletion is used for natural assets, and amortization is used for intangible assets. We'll get into a little bit more detail as we go, but let's start through Chapter 9. Okay. The first thing we're going to talk about is how we measure a cost of a plant asset. And we look at different types of plant assets. A plant asset is a long-lived, tangible asset, which means that it has physical form and substance. You can see, you can hold, you can touch it. Examples of plant assets or tangible assets are land, buildings, equipment, furniture, automobiles. And you can think of more. There's another one that they're going to have that's called land improvements. That's not on here. But each one of those are examples of long-lived assets that are going to provide utility to a business longer than 1 year. And we're going to talk about how to depreciate these particular assets. The first thing we're going to do, though, is look at what's defined as a plant asset. And here it is. It says it's differentiated from other assets because it's long-term and has a useful life for several years. If we think about this from us as individuals, most of us probably own a car. Well, if we own a car, that's considered a long-term asset for us. And so that's going to be a long-lived asset because it's going to provide us utility for more than a year. And then what we're going to do is we're going to use something called depreciation to expense that asset over the long term. And we're going to look at three types of depreciation. We'll get into that here in just a little bit. How do we differentiate it? Well, we look at and here they use a car as an example. It looks like it's a Volkswagen Passat. They look at the acquisition cost, how long we're going to be able to use it, and what we're going to get for it when we get rid of it or when we sell it. The acquisition cost, we'll talk about how to calculate that, and how the usage is where we're going to determine how we depreciate it. And the disposal cost might also be called residual or salvage value, depending upon which books you look at. So, a plant asset is recorded at historical cost. Historical cost, that follows the cost principle in accounting, which says that you record stuff at the value that you paid it. Why do you want to do that? Because you don't want to increase the value of what you paid for something, because you cannot substantiate that value from a conservative perspective. If you know exactly what you paid for it, that's what you're going to put it on the books for. And that's going to be the actual cost. The purchase price plus any taxes, commissions, and any other amounts paid to get the asset ready for its intended use. So, for example, if you bought a pickup truck and you were a plumber and the pickup truck didn't have a plumber's bed, it just had a plain old bed, and you wanted to put a utility bed on the back with toolboxes and all that stuff, and it didn't have any of your signage, and maybe you wanted to wrap that truck with the company logo. Well, wrapping the company logo and putting that box on the back of the truck would be considered cost added to put the truck into use to get it ready to be used for the plumbing business. Okay, so we have something here. We're going to talk about land and land improvements. Land is differentiated from land improvements in that land does not depreciate. Just pure, raw, simple land. If you had 100 acres that you bought, it will not depreciate. But what you want to look at, but you're still going to put it on the books, and you're going to include the purchase price, the brokerage commission, any survey or legal fees, any delinquent or property taxes that you had to pay in order to get it, title transfer fees, that's going to be from the title company, including title insurance. And if you're trying to get the land ready to the cost of clearing the land, let's say you buy land and you're going to put a Dollar General on it. Well, if they're trying to get the land ready, then there's going to be a cost of that as well. So that's going to be land. And things that are not included in land, but will be included in land improvements are going to be fencing, paving, sprinkler systems, lighting, and signage. All those are things that are land improvements, because you're taking that land and you're making changes to it and getting it ready to do your business. And land improvements, unlike land, are subject to depreciation. And so let's take a look at our first example. Smart Touch Learning purchases land on August 1st, 2015 for $50,000 with a note payable. Other costs related to this transaction are $4,000 in delinquent property taxes, $2,000 in transfer taxes, $5,000 to remove an old building, and a $1,000 survey fee. The additional costs are paid in cash. So all these costs are costs that were going to be used to capitalize or put the value of land on the books. I want to point something out here as well that I think is really important. Let's say that it cost them $5,000 to get an old building removed, but somebody was willing to pay them a certain portion of money for parts of that old building. Maybe they recovered $1,000 of that. Well, that's going to be an add back to this, and that's not included in this, but I want you to be aware of it. So you look, they paid $50,000 for the land. That's what they paid. That's what their contract price was. Then they had all these other adds, with some total: the property taxes, the transfer taxes, the removal of the building, and the survey fee, and it comes up to be $12,000. So when they put this land on their books, they're going to put it on their books for $62,000, and they will make certain to maintain all these invoices in the file that they show where they've capitalized or put this land on their books. So even though they paid $52,000 to get it ready for its intended use, it actually got up to $62,000. Now, how do we do the journal entry? We're going to debit land for $62,000. They took out a loan for $50,000, a note payable, and the other they paid in cash. They probably paid a local contractor with a front end loader and a trailer and a truck and all that stuff to clear the land, and all the other stuff that they cost them, all their closing costs. They paid all those in cash. So they're going to put this land on the books for $62,000. And when they capitalize it, it means that they are debiting an asset for the land, and they're increasing that asset. That's basically what they're doing when they're capitalizing. Now, buildings, when they have a building, these are the costs that are going to be included: architectural fees, building permits, contractor fees, payments for materials and labor. Remember, it's any value that is intended to get the structure up to its usable, something that you can use. So these are all things, in addition to what you paid for it, the brokerage fees, delinquent taxes, and renovation costs. All those are also going to be capitalized or put in the long-lived asset called buildings. Machinery and equipment is another asset, and we're going to talk about the purchase price less any discounts, transportation charges. That's transportation charges bringing the equipment there, insurance while in transit, sales taxes and other taxes, if you paid a commission on it, installation cost, and testing cost. Now think about this for a minute. I worked for a company that they said you could not buy a comparable piece of equipment from a supplier if you could in fact acquire that from another one of your facilities. Well, if they capitalize the cost of running all the electrical and water lines and everything to a piece of machinery or equipment, the machinery equipment that you could buy external definitely would be cheaper because it's not going to include all those incremental installation costs, the second to last point. So that's kind of an interesting policy from a company perspective. You thought it would save them money, but in fact it didn't, because people did not want to get assets internal to their company. They would much prefer to buy them external. So I think that's probably an interesting thing to point out here. If you have furniture and fixtures are going to be desks, chairs, file cabinets. And typically they're going to be bought in one group. Some businesses will capitalize these if you buy them in a big group. But if you buy them as individual fixtures and stuff, they may say, no, we're going to expense those. Some of this stuff with these long-lived assets is up to the discretion of the company, and it changes, so it's not always the same. But these are furniture and fixtures. And then if you have a lump sum purchase of assets, in other words, you buy land and building, or you buy a couple of different things, what you're going to do is you're going to allocate the cost of those assets back based off of the fair market value of the assets. So if we bought assets, and we're going to look at this relative market value. So let's use this example here. Smart Touch Learning paid a combined $100,000 on August 1st, 2017 for land and building. So the appraiser doesn't break out, the appraiser says that the fair market value of the land was $30,000 and the building value was $90,000. So we have $120,000 for the appraised value, but they only paid $100,000. First of all, it looks like good business because they paid $20,000 less than what it appraised at. But what we're going to do is we're going to take these two values and use those two values to ratio or multiply against this $100,000 to determine the value that each one of those should be put on the books for. And here's what we did. Here's the simple math. We took the market value of both, come up with 120,000, divided 30 by 120, it says 25% of the value is going to go to land, and the remaining 75% likewise is going to go to the building. So there's the distribution. So when we do our journal entry, this is how it'll look. They're going to capitalize land for 25,000, and they're going to capitalize building for 75,000, and you have notes payable for 100. Now, here's something that's kind of interesting, and we'll illustrate this in a minute. But let's talk first. There's capital expenditures and there's revenue expenditures. You say, okay, so capital expenditures increase the capacity or efficiency of an asset's useful life, whereas revenue are just basically expenses. So let's look at a simple example. If you have a vehicle and you are changing oil for that vehicle or putting tires on, those are revenue expenditures. But if you have that same vehicle and you're putting in a new engine or a new transmission, those may or may not be considered the capital expenditures. Some businesses might use the discretion and say, no, we're going to use those as revenue expenditures, and others may say capital. But definitely, if you have a truck that the engine is blown and you put in a new engine, you're going to extend the asset's useful life. But there's a certain amount of discretion that you can use in these capital expenditures or accounting for plant assets. It's not as cut and dried as you think. And you can see here's kind of a breakdown, and they talk particularly about vehicles. You notice here it says major engine or transmission overhaul, modification for new use, addition for storage capacity, anything that increases the life of an asset. Now, I'll add one more that's kind of interesting, and this is kind of a real-world example. One of the companies that I worked for, we had a policy that you could not capitalize a roof unless you went all the way down and tore off the decking. So if you're looking at your house, it would be you'd take the shingles off, you'd take the tar paper off, and you would take off the plywood. Then you could capitalize the roof. But if you only went down to the plywood, you couldn't capitalize it. That would be a revenue expenditure or repair. So that's kind of the difference between the two, and I want to be clear on that. And it just takes a little bit of time to understand that, and each business is a little bit different. There's three ways that we depreciate assets. The first one is called straight line, which by definition means we're going to have a straight line depreciation each month the same. We have units of production, which the simplest example would be to look at a vehicle and look at the amount of miles that are driven, the expected amount of miles and the miles that are driven each year to determine how much you would expense. And the last one is an accelerated depreciation method called double declining balance. And you use twice the straight line rate to do the double declining balance. And we'll get into that in just a few minutes. So the whole intent of depreciation is to match revenues and expenses. Imagine if you bought a semi-truck that had a useful life of 4 years and 200,000 miles, and you paid $100,000 for this truck, and you expensed it all the first month that you bought it. Well, what would happen in that? First of all, that would be cash basis accounting, and second, what would happen is you'd have issues with your financial statements because January, if you bought it in January, would be wrong. But then every subsequent month from January until month 48, if it had a 4-year useful life, would be wrong as well. They'd be wrong by a very small amount each month relative to January, but they would be wrong because you'd have a humongous bad error in your income statement in January and several little bitty good impacts the financial statements the remainder of the year, the remainder of the time that you've had that particular truck. So it's not really a very good situation to do that. And you want to match revenues and expenses because that's GAAP. It's not GAAP. So that's why you do that. And when we depreciate it, there's three major things you want to look at. The capitalized cost, what's the value you put it at your book for? The estimated useful life, and the estimated residual or salvage value. Those are all things that are going to be important. So what we're going to do is we're going to take the depreciable cost is the capitalized cost, even though it says cost here, less the estimated residual value. And that's going to determine what we're going to depreciate over time. And you have, so in this particular example, we bought a truck for $41,000. It has an estimated residual value of $1,000 or a salvage value. That means it's what's going to be after the truck is basically used up. What are you going to sell it for if it goes to the junkyard? It's $1,000. So you have a depreciable cost of $40,000. And you have a 5-year useful life, and you also have the units, how many miles you're going to drive this truck in, I guess in 5 years. So it looks like you're going to drive about 20,000 miles per year. So the first, if we look at straight line says, and if you were to look at it on a graph, it would be for each year, it's going to be exactly the same. It's going to be $8,000 per year for the next 5 years. And the way you calculate that is you take the acquisition cost or the capitalized cost, $41,000, less the residual value. Remember, that gives you depreciable cost divided by 5 years. And it tells you that your depreciation per year is going to be $8,000. And here's what the journal entry looks like. And this is an annual depreciation number, not a monthly. So if this were monthly, if you wanted to calculate it monthly, you'd have to divide the 8,000 by 12 and find out that your depreciation is somewhere around a little bit more than $600 per month as opposed to the year. And we're using depreciation expense, and we have isolated it to truck. And we're using this contra asset account called the accumulated depreciation truck. And the net book value of the truck after the first year is the acquisition cost, $41,000, less the $8,000 accumulated depreciation, or the net book value is $33,000. And when you get done with the 5 years that the truck you're going to have a residual or salvage value on your books of $1,000. Units of production looks at allocates the depreciation of a long-lived asset based off of the units that you would use. And the best example that we can illustrate is the miles that you would drive a vehicle. You can also see it based off of, say, for example, a machine that stamps stuff out, or a machine that has a certain number of units that it can produce. But basically, you're going to take that salvage value, you're going to take the depreciable cost, which remember is the acquisition cost less the salvage value, and divide it by the number of units that you can use, that you're going to produce, or you're going to consume, expected number of units, and that's going to tell you a per unit cost that you need to depreciate that asset. And it varies by year based off of how much you use. So some people, if they have a newer car, they're going to drive it a whole lot more than they would maybe longer on in the life of the car. Or if a company has a newer piece of machinery, they may use that a whole bunch in the initial years of installation. But after you used it for a while, they may not use it as much in the later years. Because technology may have changed, or they might have lost the sale that they bought that piece of machinery for. There's a whole host of reasons why it would look different. So let's look at our example again. And what this tells you is, it says, this kind of gives you an idea of what Smart Touch expects to do. 20,000 in the first year, 30 in the second, 25 in the third, 15 in the fourth, and 10 in the fifth. So it's expecting to drive a total of 100,000 miles. So we're going to take the 40,000 depreciable cost divided by the 100,000 miles, and it's going to say that we are going to depreciate our asset 40 cents per mile. You see that here, 40 cents per mile. So in the first year, and these numbers here, this 20,000, this isn't what they expected to do. That's what they actually did. So be careful with that. It says current year usage. It says 20,000, but it's really the actual miles that they ran that truck in the first year, not the expected, which you would have saw from the other slide. So in year one, the depreciation is $8,000. And here's how it looks for the remaining years. And in the last year, I want you to be careful. The math may not work out that maybe you drove it 30,000 miles in the last year, but the maximum you can depreciate it in the last year is to where you get to your total depreciation value of $40,000. Because if not, you would not take it down to the appropriate residual value. So be careful with that as well. Now, double declining balance is a method, it's an accelerated depreciation method that allows for you to depreciate the asset at a much quicker pace. And really what that does is it allows you to expense more of the asset early on in the years for book purposes. And we're going to use twice the straight line rate. So if you remember correctly, so in order to get twice the straight line rate, the original straight line rate was 1 divided by 5, which is 1 year divided by 5 years, or 20% per year. And we're going to multiply that times 2. So we're going to depreciate this asset 40% per year. But the difference, and they don't explain this very well on this slide, is no longer are they using they're using the acquisition cost, not the depreciable cost. So we're going to take 41,000 times 2 times the straight line rate, which is 1 year divided by 5, and it tells us that our depreciable cost is $16,400 in the first year. And then we come up to our new depreciable cost is $24,600 in the second year. And that comes over here. 24,600 times twice the depreciable rate. That straight line rate. 9,840. And now we're going to take that and we have an accumulated depreciation. So our next depreciation is 14,760. Twice the straight line rate, etc. But you notice in the last year here, there is no calculation, because we can only take the value of our asset down to $40,000, our total accumulated depreciation. So in effect, what we've done is we've backed into this number, 4314. And I'm going to introduce you to a new term in accounting. It's called the plug figure. A plug figure means that that's the number you need to make your numbers balance. So sometimes you hear something, they'll say it's called a plug. And if you look at the three depreciation methods, this is a little bit of a trick question, but I'm going to ask it here anyway. Which of the depreciation methods gives you the highest annual depreciation over the life of an asset? The answer is none. They all give you the same depreciation over the full useful life of an asset. If you looked at each one of these, if you went back on each one of the slides, at the end of year 5, the accumulated depreciation for this asset was $40,000. Now, if you looked at it by individual year, the numbers would look differently. But if you look at it in total, they are going to be depreciated $40,000 overall for 5 years, excuse me. Now, here's something that we haven't talked about at all, but you also have depreciable cost, where you have the tax depreciation and the book depreciation look different. And the IRS allows you to use something called Modified Accelerated Cost Recovery System for depreciation, and it divides the assets into 3, 5, 7, and 30-year terms. And I show you this so you can get exposed to this particular concept as well. It's different than the double declining balance. And the reason that I bring it up is you're going to have a difference between what you report to the IRS and what you report on your books. So that's going to be a book to tax reconciliation. And for some of you guys that are going to be tax accountants, you'll get that sometime into the future. So here's how the assets are reported on their book. They have furniture, and then they also had building for Smart Touch, and then they had land. And their total is $97,450, and that's their plant assets net. Now we have entries for disposal of plant assets. A disposal is when you get rid of an asset for one reason or another. You can discard it, which basically means you throw it away. You can sell it, or you can exchange it or trade it in. And each one of these, what's the one thing you want to remember, there's a couple steps, but the one thing you want to do first is you want to update the depreciation for the current year. So maybe the depreciation was posted through December. You need to update the depreciation for the current year. Then you need to cancel out the depreciation for the current year, and you need to cancel out the asset. And any difference will be a gain or a loss if you sell or discard it or whatever you do. So let's look at some of these journal entries, and here's the 4 basic steps again. Bring the depreciation up to date. Remove the old asset from your books, both the accumulated depreciation and the asset. So what that means is you're going to debit accumulated depreciation, you're going to credit the asset, and then you're going to record any cash you receive for that asset. And if it's zero, that means you probably just disposed of it. And then you're going to determine what if you had any gain or loss. And this is going to be basically, we talked about plug just a minute ago. That's the difference that it's going to be. So you're going to debit accumulated depreciation, credit the asset, and if you have any cash that came in, that's going to be a debit. And any difference between those, the sum total of all those, is going to be a net debit or a net credit. If it's a net credit, it's a gain. If it's a net debit, it's a loss. And if we look at Smart Touch Learning, here's one. They got rid of some equipment with the cost of $10,000 and accumulated depreciation of $10,000. So this is a fully depreciated asset with no net book value. So there was no gain or loss on the asset. That's the first one. The second one, it says they got rid of it, but it had a net book value of $8,000, of $9,000. So here's the next one. They got rid of it in July. They needed to update the depreciation first. That's the other $500 to make their accumulated depreciation $8,500. They just got rid of it. They scrapped it. They didn't get any money for it. It just went to the boneyard. Nobody paid them for it. Well, the difference between what they carried it on their books at $10,000 and their accumulated depreciation of $8,500 is a net debit, which is a loss or a bad guy of $1,500. And now here's the next one. If they sell the equipment for $1,500, they have no gain or no loss. If they would have sold it for more, they would have had a gain. If they would have sold it for less, they would have had a loss. So let's look. So here's another one. They sold it for $4,000. Well, now your net debits are $12,500, and your net credits are only $10,000. So you have a gain of $2,500 on the sale of that asset. That's a net positive gain. So that's what's going to happen with that. Now, if you sold it for $500, you're going to have a net loss because your net debits are $9,500 or $9,000, and your net credits are $10,000. So this becomes your plug of $1,000. Each one of those is a little bit different. And you can take a look at each one of these, and it's got to give you another view of the same stuff that we talked about. Summary and more summary. And let's talk now about natural resources. Natural resources are assets that are non-renewable resources, and we're going to deplete those. And we use basically the units of production or the units of activity method for depletion. So that would be like how many barrels of oil do you have on land that you've determined, or how much timber, even though timber you think is non-renewable, it's renewable, it's not renewable for the purposes of depletion because basically they start all over after they clear cut some timber. So it's going to be depleted. Now, if you had a field of corn, you're going to renew that every year. You're not going to renew that, every, say, the timber stuff might be every 30 years. So that's going to be much more depletion. So we look at this particular oil example, and it says that you have you paid $700,000 for oil, and you expect to get 70,000 barrels of oil out of it in a year, and it has no residual value. So if they take out 3,000 barrels, you're going to take the 700,000 divided by the 70,000, and it says it's $10 per barrel is the depletion. And if you did 3,000 barrels, your depletion cost is going to be $30,000. $10 times 3,000, which gives you $30,000. And that's just an example. It looks exactly the same as the units of activity. The only difference is you're using depletion and not depreciation. Intangible assets. Intangible assets are things that you cannot have, hold, and touch. Some examples of intangible assets are patents, copyrights, trademarks, and there's other things, and we'll talk a little bit about each one of these as well. First, patents or intangible assets are amortized. They're amortized over a period of time, so it's different. And another difference you're going to see is you don't have an accumulated amortization account. It goes directly back to the original asset. So we have something called impairment. An impairment of a intangible asset means that it no longer has value. So let's say I had a trademark asset on my book for some type of a business. let's say I had Huggies on my books and as a trademark, and Procter and Gamble bought Kimberly Clark and they did away with the Huggies brand, and so they no longer have that trademark. So when they first bought it, they might have had value, but they no longer do. Well, they have to report a loss when impairment to that asset comes. Okay, so let's talk about patents. A patent is conveyed by the federal government. In other words, it's granted by the federal government and allows a company to sell an invention for 20 years with nobody else to do anything. And it's an invention that can be a process, product, or formula. And the cost of the patent is debited to the patent account. So an example of that might be the Kodak Instamatic camera might be was something that was patented long ago that we might all have seen. So here's what they do for patents. They have a $200,000. They acquired a patent on January the 1st. It has a useful life of 5 years, and we're going to use a straight line. So it's going to be $40,000 per year for the patent expense. But you notice here, the $40,000 we're taking and we're going to debit amortization expense patent. But now no longer are we going to credit an account called accumulated amortization patent. We're actually going to credit the patent or the asset directly. A little bit different than what you saw in plant assets. Copyrights and trademarks. Those are things that you can reproduce a book or a musical or something of that nature. And you can think of that like copyrights for music. If some of you are at church and they flash words up on the screen, when they flash those words up on the screen, they actually have to pay a copyright every time they show those. So your church, the person that's in your sound booth is keeping track of what songs you sang, and also you're going to have to pay the copyright people that. So you have to pay copyrights for that. Another example, the Happy Birthday song used to be copyrighted. So when you went to a restaurant, they would sing their own version of a Happy Birthday song. They would not sing the traditional Happy Birthday song that you might sing at your home, but they've just changed that, and it's no longer, the Happy Birthday song is no longer copyrighted. A trademark is a name that represents a distinctive thing, like the Nike Swish or the Golden Arches are a couple of trademark things that you might see. You might also see some trade names like Kleenex. Those are trademarks. Franchises are given to businesses to sell goods or services. And you can look at, for example, McDonald's and Subway are franchises. What they really do is they charge people for their know-how, and they charge them for a franchise. They charge them a franchise fee. You can also see, for example, that Century 21, a real estate company, is franchised. And if you read their signs closely, it'll say on the bottom of it, each office is independently owned and operated. And you can also have licenses. This last one, are privileges granted by a government to use public property and performing services. That's a license. So I have a real estate license. That's an intangible asset. Those are some franchises and licenses. And then goodwill is probably one of the harder ones you want to take a look at. Essentially, what goodwill is, it's the difference between the value you've paid for an asset and the value in their worth. So let's say I'm running a donut shop in Commerce, and I decide that I want to buy up the other competing donut shop in town. And I go buy up all of his cooking equipment, and he has a delivery truck, and he has a couple other things. And I pay the proprietor of the other donut shop in town $200,000. But when I get a fair market valuation of the assets, I find out that his assets are only worth $120,000, and I paid him $200,000. The difference between when I paid him the $200,000 and the $120,000, which is the fair market value, is called goodwill, and it's an intangible asset on the books of a company. And they do impairment tests off of goodwill because they have to determine whether or not it's going to, if in fact that goodwill is warranted to be on the books. And goodwill is not amortized. It's only tested for impairment, and if it's impaired, it's going to be expensed. And for some of you guys that you take Accounting 321 or 322, you'll learn a little bit more about impairment test for goodwill. So here's how you look at intangible assets. And this isn't just intangible assets, what they have here. This actually has all three. You have plant assets that are depreciated, Natural resources like timber and oil are depleted, and intangible assets are amortized. Remember, these last two are going to be done. Typically, you're going to use straight line here. Typically, you're going to be using units of activity here. And you're going to have three approaches here: the double declining balance, straight line, and units of activity for depreciation in this one. And use depreciable cost for units of activity in straight line, and use the acquisition cost for the double declining balance. There's also a depreciation method that's used for tax that's different than a book called Makers. And I think that's it for Chapter 9. I wish you well and look forward to seeing you in Chapter 10. Have a great day.